Good evening, ladies and gentlemen. My name is Corey, and these are my associates Anika and Jing, and we're going to dive into the wonderful world of cheesemaking through the eyes of Fromagerie Dupré, also known as FP. So for our analysis today, we'll be covering the following topics: accounting issues, financing alternatives, the expansion plans in both terms of the GC acquisition and the website implementation. We'll talk slightly about taxation issues, and then we'll conclude with our recommendations. I now give the floor to my associate Jing, who will cover the accounting issues.
The major accounting issue, the first one, is the recognized 180K revenue in 2008. Although the customer has paid part of money, but the delivery hasn't been done, and no case factor supports there is a bill and hold arrangement requested by the customer. So this money should be recognized in 2009 when the delivery has been done instead of 2008. Another major issue is about the government assessment. There's a 640K government assessment. 100K government assessment was granted for the production employee salaries, which should be including in the net incomes of the expense when it occurs. Another one is a 540K was granted for the acquisition of the net asset, which could be deducted to the PPE account when it occurred, or to better inform the investors about the detailed information, it can be treated as deferred income and amortized in the following 15 years. Another major issue is land rental agreement. FP was required to pay 600K to return the land to its pre-leasing conditions. We assume the FP has made a major land improvement to facilitate its productions. And currently, this amount hasn't been included in the financial statements and not even in the disclosure. However, this amount has qualified for all the definition of liability, and it should be recorded as a liability. At the same time, the same amount should be capitalized to the land approved account and amortized in the following 15 years. The last thing is recognition of an intangible asset. The first one is the market development fees. Currently, the FP capitalizes all the promotion fees and the fees to attend cheese competition to generate public awareness. However, customer loyalty and public awareness cannot be separated from the FP and is therefore to be transferred or sold to others. So it doesn't meet the criteria for the identifiability definition of intangible asset. Also, this cost cannot be, there's no binding agreement with FP and its customers to secure this economic benefits in the future. So we decide to expense it in the year when the cost occurs, which will decrease the net income. The last thing is the milk contract. Currently, the FP capitalized the cost to secure this high quality milk. And this milk meet the criteria for intangible assets and its recognition criteria. It can be treated as intangible asset. However, the amortization fees should be amortized in the following 3 years, and it should be included in the inventory and the cost of the sales. Now let's go back to the Corey for the further analysis.
So now we'll take a look at the two financing alternatives that FP has to fund their potential expansion plans. On one hand, we have private equity investment from Martin Brie, and on the other hand, we have a combination of debt and equity from the financial institution BCR. Qualitatively, Martin Brie offers several advantages, the main one being the fact that he would not only be an investor, but also a strategic partner. With several years of experience and knowledge of the cheese industry, he can add intangible value to the FP team for their potential growth. When we look at the qualitative facts supporting BCR, we have to consider one major thing, that the preferred shares that would be issued to BCR are retractable or redeemable. This means that they would not, in fact, be recorded as equity on the balance sheet, which would not trigger any fees related to the government assistance package. So now that we understand the qualitative, let's look at the quantitative. So in order to assess which financing alternative will cost more, we have to take On Martin Bree's side, the present value of the cost that will be the fee paid to the government for breaching their government contract, and from BCR, we'll actually take the present value of the interest payments to be made on the loan. So when we look from a quantitative standpoint, the costs associated to breaching the government contract are far lower than the present value of the interest payments. So not only quantitatively is Martin Bree's offer better, but also qualitatively, the fact that he would be a strategic partner is really the more advantageous route in terms of financing. So now that we know that we would truly want to finance with Martin Bree, we will see what this financing will allow FP to do.
Thank you, Corey. So there are two expansion projects on the table for GC. So the first one is the acquisition of GC, and the second is the development of their customer website. So let's look at the acquisition of GC. So the advantages of the acquisition of GC would be that they would acquire the state-of-the-art facility, which would give them a lot of competitive advantage. The second is that GC has agreements with two of the most prestigious suppliers of raw goat milk, and that's consistent with FP's mission statement to produce high-quality cheese. Now for the disadvantages. So the asking price we think is very steep at $500,000, especially because they'll have to take on the $1 million debt and pay it off. Second of all, GC's financial statements are unaudited, which means that they cannot be relied upon, and we don't know if they're representative of GC's financial situation. Also, GC failed to market their products, which could mean one of two things. So first of all, it could mean that there just isn't a market for the products, and the second thing it could mean is that they'll have to spend a lot more on marketing to promote the products. And last but not least, the contracts with the prestigious suppliers are actually scheduled to expire less than 3 years after the potential acquisition, which poses a big element of risk because we don't know if they're going to renew the contract. So based on the qualitative analysis alone, we would suggest that FP does not acquire GC. Now let's move on to the quantitative analysis. So as you can see here, what we did is a discounted cash flow for the years 2009, 2010, and 2011. So the discounted cash flow with a rate of 13% could be seen here at 98,220 in the negative. We actually did experiments with different discount rates to account for different levels of risk, but all of them resulted in a negative cash flow, which further supports our conclusion of not acquiring GC. And now we move on to the implementation of the customer website. So this is all about internal controls. There were a lot of them, but the major ones were the refund policy, the shipping procedures, and the customer ID security. We're not going to go into too much detail for the purpose of this presentation, but a full analysis on control weaknesses can be found in the written part of our project. Thank you. Back to Corey.
Thanks, Anika. So now let's take a look at some of the taxation issues that arise with FP. So we noticed that FP was simply taking their net income for accounting purposes and saying, hey, that's the same for tax purposes. As we both know, accounting and tax have several differences, and several adjustments needed to be made in order to get their taxable income. One of these adjustments was adding back depreciation. Now, when we did our calculations and took the taxable incomes for the years since operations, we noticed that FP has incurred taxable losses for the years 2006 through 2008. This is extremely important to note for FP so that they can know to carry forward these non-capital losses to further mitigate and reduce the tax liability that they will have in years where they actually earn taxable income. The first year that they earn taxable income is in fact 2009. However, they have incurred so much taxable losses from prior years that they can fully reduce their tax liability using these non-capital losses carried forward. So in conclusion, through our experience with FP, we learned so much about them and so many good things about them. Only 3 years in existence so far, and they have already experienced a tremendous sales growth and have already established themselves with a brand that is synonymous with a high quality product and integrity. However, they have seen some, after doing a cash flow analysis, we were able to determine that they are on a stringent cash flow budget and really do not have many funds to allocate for some of their objectives, such as paying out management salaries and repaying the loan that was given to them by their father. This kind of does not coexist with the fact of their expansion plans, because not only does it take money and not only will they incur more debt, but they will kind of make their cash flow situation even tighter and even less possible for them to reach their objectives to eventually pay out management salaries and pay back their father. Pretty much what we are saying is that perhaps they are moving a little too quickly, too soon in their business life cycle. They have experienced a great start to date and are starting to earn some net income that is in positive, and are starting to repay some of their fixed costs from the start of their incorporation. However, if they incur these expansion costs too early, it might be too hard for them to overcome all of the fees and debt associated to it. Basically, a wise man once told me that you can't have your cake and eat it too. It seems that this statement holds true for cheese as well. Thank you.